Welcome to our channel. This video is all about how corporate finance is important for a company's success. I have discussed why capital budgeting is so important, the process of deciding which projects to invest in, and how companies manage their working capital. It's basically about how companies use their money to meet their financial goals and how they can make smart choices about investments and spending. Corporate finance is very important because companies need money to do well, everything. So it's all about figuring out where that money comes from, how to use it wisely, and making sure there's enough to go around. One way companies get money is by selling shares or by borrowing it from banks or other investors. Investing always comes with some risks, but corporate finance helps companies find the right balance between risks and potential profit. Once they have money, they have to decide which projects or investments to make. They need to choose the ones that will bring in the most profit and add value to the company and its shareholders. To do this, they use tools like net present value (NPV) and internal rate of return to help them evaluate different options. Another important part of corporate finance is managing working capital, which is basically the money a company needs to cover its daily expenses and keep operations running smoothly. Companies need to make sure they have enough cash on hand to cover those expenses and that they are not sitting on too much cash either. It's all about finding the right balance. Capital budgeting is a huge part of corporate finance. It's all about deciding which long-term investments to make, like buying new equipment or property. It's like a plan for using limited resources on projects that have the best chance of success. To do this, companies use tools like NPV and IRR to evaluate different investment options and make sure they are making smart choices. Corporate finance is important for any company that wants to survive and thrive. It helps them make smart decisions about money, manage their resources, and grow over time. Let us discuss about why capital budgeting is so important for companies. We all know that companies only have so much money to spend, so it's important to choose the right projects. Capital budgeting is a way for us to figure out which projects will give us the best returns and increase the value for our shareholders. The decisions we make today can really shape the future of a company. Capital budgeting helps us make sure that the money we invest now will help our company grow and stay strong in the long run. Now, investments come with risks. Capital budgeting helps us understand these risks and rewards better so we can make smart decisions. The whole process is like planning a road trip. You need to figure out where you want to go, your goals, plan your route, project analysis, decide which car to take, decision making, and then keep an eye on your fuel tank monitoring. Along the way, the capital budgeting process has a few steps. Project identification. This is where we brainstorm about new investment ideas that fit with what the company wants to achieve. Project analysis. We take a close look at each project to see how much money it's expected to bring in and spend. We use tools like the net present value, internal rate of return, and payback period to figure out if a project is profitable and how risky it is. Decision making. After analyzing, we compare projects and decide which ones to go ahead with, which ones to pass on, or which ones might need some changes. We think about things like how well the project fits with our goals, how much risk we are willing to take, and what's happening in the market. Implementation and monitoring. Once we have made a decision, we put it into action and keep an eye on how it's doing compared to what we expected. If something isn't working out, we can make changes. The net present value is a useful tool that helps us understand the value of money over time. It tells us what a rupee today is worth compared to a rupee tomorrow. If a project has a positive NPV, it means it's expected to add value to the company. The internal rate of return is like figuring out what interest rate would make the NPV of a project zero. It gives us an idea of what the annual return on investment for a project could be. If the IRR is higher than what the company needs to pay its investors, then the project is considered good. The payback period is how long it takes for a project to earn back the money that will initially invested. It's simple to understand. but it doesn't take into account any money that comes after that period. So it might not be the best choice for projects that take a long time to pay off. There's no one size fits all method for all projects. The best choice depends on things like what kind of project it is, how risky it is, and what's important to the company. NPV and IRR are often used because they take into account how money changes value over time. But sometimes knowing how quickly you can get your money back is also important. Just looking at numbers on a piece of paper isn't enough to make a smart decision. You need to think about how the project fits into your company's bigger picture, what's going on in the market, and any long-term benefits it might bring. The cost of capital is the least amount of return investors expect from their money. So any project you take on should make more than an amount. Sensitivity analysis is about considering how different things like changes in interest rates or sales could affect the project's success. Capital budgeting is all about making smart investments. By using the right methods and thinking about all these factors, you can make decisions that help your company grow and create value for your shareholders. Raising money to run your business is like going to the bank. It's called capital financing, and it's essential for any company that wants to grow. Getting the right mix of financing options can make all the difference between success and failure. There are two main ways to finance your business: debt and equity. With debt financing, you borrow money and then it pay back with interest. This is like taking out a loan from the bank. The advantage is that you don't have to give up any ownership in your company. Some common forms of debt financing are term loans. These are fixed rate loans with a set repayment schedule, often used for buying equipment or funding expansion projects. Lines of credit. These give you flexible access to money so you can borrow as you need it and repay when you can. This is helpful when you have short-term cash flow issues. On the other hand, with equity financing, you sell a piece of your company in exchange for capital. Investors who buy shares become part owners and may receive dividends or benefit from the company's growth. Some common forms of equity financing are selling stock. This is when a company goes public by offering shares to the public through an initial public offering (IPO). The shares are then traded on a stock exchange. Investors provide funding to startups with high growth potential in exchange for equity. Angel investors. Wealthy individuals invest in early stage companies, often providing not just capital but also mentorship. Both debt and equity financing have their pros and cons, and smart companies often use a mix of both to balance risk and reward while working towards their goals. The choice between borrowing money or selling shares in your company really depends on where you are at. When you are just selling out, it's usually easier to sell shares because you don't have a track record of paying back loans. Selling shares means giving away a piece of your company, but it means you don't have to worry about repaying anyone. Borrowing money means you are on the hook to pay it back, even if things are not going so great. That can be risky, but if your company is doing well, you might be able to get better loan terms. On the other hand, if you sell shares, you get more cash, but you lose some control over your company. It's kind of like having investors. They might have ideas about how you should run things and you will have to work with them, but it also means you don't have to worry about repaying them. There are other ways to get money too. Hybrid financing is when you borrow money but also have the option to give shares to the lender. It's kind of like having your cake and eating it too, but it can be complicated. Government grants are money from the government for specific projects like research or starting a new business. They don't usually come with strings attached, but it can be hard to get one. Crowdfunding is when you ask a lot of people for small amounts of money, usually online. It's like having lots of investors, but they usually don't expect anything in return. No matter what you choose, make sure you have a plan for how you are going to spend the money. Think about what you need it for, how much it's going to cost, and what kind of impact it's going to have on your company in the long run. Keep an eye on the economy and what's going on in the financial world to know when it's the best time to get money. And remember, there's no one right answer here. It's all about finding what works best for your company and your goals. Working capital management, or WCM for short, is basically about making sure your company has enough money to pay for everything it needs without ever running out. It's like making sure you have enough cash for expense and savings all at the same time. And just like with personal finances, WCM is all about keeping track of your assets and liabilities, what you own and what you owe. Having plenty of liquid cash on hand means you can pay off short-term debts and avoid financial trouble. Good WCM helps you use your resources wisely, which can lower cost for storing inventory and make your business run more smoothly. Paying your suppliers on time and shipping out orders fast builds trust with them and keeps your customers happy too. Proper WCM helps you avoid situations where you run out of inventory or have to delay payments. Use lean manufacturing techniques to reduce waste and just-in-time systems to get the inventory you need when you need it. Negotiate better deals with your suppliers to lower cost and get longer payment terms from your customers to keep more cash on hand. Make your billing process as smooth as possible and enforce strict credit policies to get paid faster. Ratios like the current ratio and inventory turnover ratio can help you keep track of how well you are managing your working capital. But remember, WCM isn't just about hitting one number. It's about finding the right balance between having enough cash on hand and keeping your cost and risks under control. Too much inventory can tie up cash, while too little can lead to stock outs and lost sales. Likewise, while longer payment terms can help with cash flow, they shouldn't hurt your relationships with your suppliers. Working capital management is all about keeping your business healthy and growing. It's not rocket science, but it does take careful planning and attention to detail. So stay on top of your numbers, keep an eye on your cash flow, and don't be afraid to tweak your strategy along the way. Your business will thank you for it. Corporate finance helps companies decide where to spend their money, how to get more and when they need it, and how to manage their daily cash flow. Basically, it helps companies focus on long-term goals and use their resources wisely. Good planning means companies can make more money, cut costs, and find great opportunities for growth. This helps the company grow in a healthy way. Every business has risks. Corporate finance helps spot these risks early on, figure out how serious they are, and come up with plans to handle them. When a company manages its money well, it makes investors and lenders trust them more. They are more likely to give the company money if it has clear plans for its finances and has been careful with its money in the past. The three main parts of corporate finance are capital budgeting, capital financing, and working capital management. Think of corporate finance like a big loop that keeps an eye on your company's money situation all the time. It's made up of few key steps. Experts in the company look at how much money they have now, how much they expect to get in the future, and whether there are any chances to make more money or risks they should be aware of. They also decide on important money matters like how much to spend on big projects, how to get money for those projects, and how to manage day-to-day expenses. These decisions should support the company's overall goals. Once they have made decisions, they put them into action and keep an eye on how well they're working. If something's not just going as planned, they make changes to get back on track. The people in charge of corporate finance are like the engine room of a ship. They make sure everything keeps running smoothly. The Chief Financial Officer, CFO, is like the captain of the ship, making sure all the financial plans are top-notch. Financial analysts are like the detectives, digging into numbers and creating models to help make smart decisions. Treasury management is like the cash handlers, making sure there's enough money flowing in and out of the company. Good corporate finance is like a secret sauce for business success. It helps companies make smart money choices, use their resources efficiently, and avoid risks. This way, they can grow steadily, keep their shareholders happy, and stand out in the market. Even with the best plans, companies can trip up in corporate finance. Some common pitfalls include not planning for enough money can lead to cash crunch later on. So make sure you plan for some extra funds to cover unexpected cost. Not fully understanding the cost associated with different financing options like interest rates on loans. So carefully analyze the cost of each financing option and compare it to the expected return on investment. Don't just go for the quickest or easiest source of funds. Choose the one with the most favorable returns for your company's long-term goals. Excessive debt can burden your company with high interest payments and limit its financial flexibility. In a downturn, heavy debt can make it difficult to meet loan obligations. So keep a healthy balance between debt and equity financing. While debt can be a good tool for growth, prioritize equity financing to some extent as it doesn't come with fixed repayment obligations. Inefficient management of short-term assets and liabilities can really mess up your day-to-day operations and make it tough to pay the bills. It's important to have strategies in place for effective working capital management, like keeping track of inventory levels, collecting payments from customers quickly, and working with suppliers to get the best payment terms possible. Having a clear financial plan is super helpful when it comes to making decisions about where to allocate resources and spotting investment opportunities. Make sure you develop a comprehensive plan that outlines your business goals, funding needs, and strategies for sustainability and growth. Regularly review and update your plan as your business grows and changes. Being transparent about your financial situation is super important, both with investors and lenders. Hiding problems or giving them false information can damage trust and make it harder to get future funding. So make sure you are always honest and upfront about your company's financial performance and future prospects. You don't want any surprises when it comes to potential financial risks, so proactively identify them and make plans to deal with them. This could include things like economic downturns, changes in regulations, or fluctuations in currency values. Exploring alternative financing options like crowdfunding, government grants, or asset-based lending can be a smart way to diversify your funding sources and find options that better fit your specific needs. When it comes to making financial decisions, it's important to approach things rationally and use data to back up your choices. Don't let emotions like fear of missing out or pressure. Finally, don't get too comfortable with what you know. Financial landscape is always changing, and you need to stay on top of current trends and adapt your strategies accordingly. Stay informed about new developments in corporate finance and to be open to learning new things to keep your company competitive and secure the resources it needs for long-term success. Focus on projects with the highest return on investment and make sure they align with your long-term goals. Don't be afraid to explore different financing options like equity financing, venture capital, government grants, or asset-based lending. Each method has its pros and cons, so choose what works best for your business at each stage of growth. When it comes to raising capital, don't limit yourself to just bank loans. Be creative and open-minded about other options like selling company shares or seeking investments. Just remember to weigh the cost and benefits of each options before making a decision. Keep an eye on your inventory and supply chain to avoid overstocking or running out of stock. Look into smart manufacturing methods and just-in-time ordering to keep costs down. Make sure you have clear payment terms with both your suppliers and customers. Offer discounts for early payments and stay on top of collection to improve your cash flow. Use technology like financial software and data analysis tools to help you make better informed decisions. Compare your financial results with other businesses in your industry to see where you can improve. Encourage your team to stay up to date on financial trends and best practices through training and professional development. Build a diverse finance team with skills in financial analysis, risk management, and investor relations. If needed, consider hiring experts in areas like mergers and acquisitions or asset management. Communication is key when it comes to corporate finance. Keep everyone in the loop, from the CFO to other departments, heads, and team members. Offer training and resources to help everyone in the company understand finances better. This will help employees make more informed decisions and see how their work impacts the company's bottom line. Use financial metrics to evaluate departmental performance and recognize and reward employees who contribute to financial success. Be prepared for financial risks by having contingency plans in place. This could include diversifying your revenue streams, reducing your exposure to certain risks, or finding alternative strategies. Don't be afraid to adapt your plans if circumstances changes or new opportunities arise. Flexibility is key in corporate finance. Ultimately, success in corporate finance comes down to having a solid plan, staying informed, and fostering a culture of financial responsibility within your organization. It's an ongoing process that requires constant learning, adaptation, and a commitment to excellence. Thank you so much for watching. If you enjoyed this video and found it informative, I would like to receive your support. Please give it a like, share it with your friends and family, and subscribe to our channel.